Well, the parade of companies laying off employees just seems to continue unabated. Over 32,000 people have been laid off from US tech so far this year. Tech companies that boomed during the pandemic are seeing dramatically falling revenue. This is especially true of tech companies in e-commerce, real estate and those closely related to the stock market. And we are hearing about how job cuts at tech companies are crashing the housing market. But now that real estate values are crashing, what about all of the people who work in real estate? Well, as you might imagine, there are layoffs in the real estate industry as well. And today we hear that Redfin is laying off 13% of its workforce. Redfin is also shutting down its house flipping business. Basically all of the real estate technology companies are in trouble. Redfin, Opendoor, OfferPad, Compass, and Zillow. All 5 of these companies have basically been a dumpster fire since the start of 2022. All of them started buying portfolios of single-family homes near the height of the real estate bubble. Actually, they may even have been the cause of the bubble. Or, at least the catalyst. But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Redfin CEO Glenn Kelman has confirmed that it is shuttering its home flipping business. And the company will lay off 862 employees. That is 13% of its employees. 264 of those job cuts are directly from the shutdown of Redfin Now. Redfin Now is the Redfin's iBuying business. In that business, Redfin would buy a house as it is. Then, it would make minor improvements. Then it would resell the house on the open market. Winding down Redfin Now is a strategic decision we made in order to focus our resources on our core businesses in the face of the rising cost of capital, Redfin wrote in a filing with the Securities and Exchange Commission. The rest of the company's job cuts are primarily from real estate services and corporate employees at the Redfin's headquarters. 9% of Redfin's lead agent positions will be cut. That is 197 jobs. 218 employees will have their current position eliminated, but will be offered other positions. The U.S. housing market became overheated in an asset bubble. That bubble was fueled by the cheap debt of low interest rates. Now the Federal Reserve is aggressively raising interest rates. And the macroeconomic conditions are deteriorating. Basically all real estate companies like Redfin have been cutting jobs. Redfin cut 8% of its employees in June because of the slowing housing market. It now has 27% fewer employees than it had in April. Last week Opendoor cut 550 jobs. Opendoor is the largest iBuying company in the market. A layoff is awful, but we can't avoid it. We plan to keep increasing our share of the market, but that market in 2023 is likely to be 30% smaller than it was in 2021, Redfin CEO Glenn Kelman wrote in an email to employees today. The June layoff was a response to our expectation that we'd sell fewer houses in 2022. This layoff assumes the downturn will last at least through 2023, Kelman added. If you have been watching the events unfolding in real estate, you probably already know that Redfin is having a disastrous 2022. Shares in Redfin plummeted to a fresh record low this week. This after an Oppenheimer analyst downgraded Redfin shares. Oppenheimer also said that Redfin's business model was fundamentally flawed. Shares in Redfin cratered by almost 10% on Monday after the Oppenheimer report was released. Oppenheimer analyst Jason Helfstein cut his rating in Redfin shares to underperform from a hold equivalent rating. I see room for further pain. I set a price target of $1.30 per share, said Helfstein in a note to clients. We believe that Redfin's business is fundamentally flawed, as the company continues to use a fixed cost model for agents, Helfstein wrote. This prevents the company from optimizing margins when the housing markets decline and limits share gains when markets rebound, Helfstein continued. Any comments the company can share about its stock price move will be addressed on its earnings conference call on Wednesday after it releases results, said Redfin. Shares in Redfin have plunged around 91% so far this year. The United States economy is teetering on the brink of recession. Inflation is raging. The Federal Reserve is aggressively raising interest rates this year in order to fight inflation. Higher interest rates are negatively impacting the affordability of houses. And first-time homebuyers have basically been frozen out of the market for a few years now. But, now as housing sales are slowing due to higher interest rates. Thousands of people who worked in the real estate industry are facing job cuts. The housing market was booming during the pandemic. That was a result of the loose monetary policy of the Federal Reserve. And the increase in the money supply basically caused a run-up in the prices of assets. This is called an asset bubble, when too many dollars are chasing too few assets. Well, the bubble is now bursting, to say the least. The current crash of property values and real estate jobs is equivalent to what we witnessed during the housing crash of 2008. The rate of the standard 30-year fixed mortgage is now over 7%, which is more than double the rate 1 year ago. Higher mortgage rates increase the monthly payment to own a house. And so houses are now even less affordable. This basically prices many buyers out of the market. This is a stark and speedy reversal of fortune. For the past 2 years, the housing-related job market has been red hot. Work from home and record low interest rates drove tech workers out of California and into relatively lower-priced housing markets. A tsunami of buyers entered the market looking for new homes, especially in the Mountain West. Sales of existing homes peaked in 2021 at their highest level since 2006. The resulting spike in housing demand created a lot of new jobs. And it was, frankly, quite a bright spot in what was otherwise a pretty bleak pandemic-era job market. A lot of the new employees came from industries that were hit hard by the pandemic. This included hospitality, healthcare, food service, and education. Overall, thousands of jobs in the real estate ecosphere have basically vaporized. Tech layoffs are a primary reason why home prices in technology hubs fell dramatically this year. San Jose, California is down 10%. Seattle is down 7%. San Francisco is down 7%. Los Angeles is down 4%. Denver is also down 4%. The United States housing market is at a significant inflection point with many cities significantly overvalued. Boise, Idaho is 72% overvalued. Austin, Texas is 67% overvalued. Ogden, Utah is 64% overvalued. Las Vegas, Nevada is 61% overvalued. Atlanta, Georgia is 58% overvalued. Phoenix, Arizona is 57% overvalued. Provo, Utah is 57% overvalued. Housing prices are falling in many U.S. cities. But how far will they go? Experts predict that house prices could fall by up to 25% over the next few months. Home builders are having to offer aggressive discounts. And they are canceling new building projects. On the positive side, this could be an opportunity for first-time home buyers. But what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.